So performance evaluation. This is a 20% grading in your syllabus. 20%. So everything we've done so far is 80%. So we've done 80% of the syllabus, and the last 20% is this aspect. Broadly, this aspect is, among other things, divided into three. We're going to be looking at performance evaluation, where we look at the balance scorecard, and we've already done this in the introduction. If you remember, we did balance scorecard, so I may not talk about it here again. Then Fitzgerald and Moon building block, we will look at that one as well in relation to that. From there, we will look at some financial performance appraisal, like using the residual income RI, and then return on investment ROI, and then sometimes to talk about issues in relation to ROCE, return on capital employed. So we look at that aspect as well from the in this discussion. And then the third thematic area of this topic is the issue in relation to transfer pricing. Transfer pricing. Primarily, the bigger chunk of this topic is about divisional management, where organizations have various divisions. So a car manufacturing company could have division for the tire manufacturing, they could have a division for the seat manufacturing, they could have a division for the windscreen manufacturing. At the end of the day, we will have the head office also there, which manages all of these divisions. Now, at the end of the day, we will have the assembling department who is going to then put together all of these things and now sell the finished products to the outside world. The question is, at what price can the tie division sell their tie to the assembly division, seat division sell their seats to the assembly division, so that the finished goods will now be assembled and sent outside? That is the question we'll be answering when we are dealing with transfer pricing. So thematically, this topic, performance evaluation, looks at three major things. Performance evaluation modules, the balance scorecard, Fitzgerald and Moon. There are other two called the performance pyramid, and also the performance prisms. So, but we will not be looking at these two. We will just focus on the balance scorecard and Fitzgerald and Moon building block. Then we'll look at how we calculate these indicators, very critical of the syllabus, and then how we will deal with transfer pricing. So these are the three thematic areas of the topic. So let's begin the discussion with divisional performance management. Divisional performance management. Now, note that this area we're going to be doing a lot of reading, a lot of writing. Okay, we're going to be doing a lot of reading and writing here. So you make sure that you stay with me closely in relation to that. Now, when organizations are choosing organizational structure, one of the suitable organizational structure organizations always go for is to have what we call a divisional organizational structure. What does that mean? It is when the entire entity is divided into what? Various divisions. But when we divide the entire organization into various divisions, there are a couple of challenges that companies have. So the first thing we want to look at is the challenges, or if you want, problems, challenges or problems of divisionalization. So the first thing we want to discuss is challenges or problem of divisionalization. We are looking at performance measurement. We started about 4 minutes ago, and I said thematically it's about these three areas. performance evaluation modules, balance scorecard, and Fitzgerald and Moon building blocks. And I said there are other two, but we won't look at them. Performance pyramid, performance prisons. The second area of this topic is using performance evaluation financial indicators like residual income, return on investment, and ROCE. And then the third one is transfer pricing. For instance, when a car manufacturing company has various divisions, the question is, at what price can one division sell its good to another division? That is the transfer price. So these are the three thematic areas, and we are starting with divisional performance measurements. No. You actually, I won't talk about them. So these two are the most important: the balance scorecard and Fitzgerald. So, what are the challenges companies face if they divisionalize the organization? Any ideas? Any ideas? What challenges do companies face if they have, like, see, this is a car manufacturing company, and these are the divisions: tie, seat, windscreen, head office is there, the assembly department is there. So, what challenge do you think the company will face? The car manufacturing company, let's say Rolls-Royce. What challenge do you think they will face? Any idea? Allocation of resources. Okay. When you say allocation of resources, what do you mean? How the head office allocate resources between them. That's it. Okay. Yes, that could be a challenge that an entity faces. What else? What else? You know that if we do divisionalization, or if we now divide the entity into various divisions, the head office doesn't exist for its own. The head office exists because of what? The various divisions. It means at the end of the year, at the end of a period, the cost incurred by the head office would have to be what? Apportioned. But the question is, how do we apportion head office costs among the various divisions? That is one of the what? Challenges that we are going to be looking at. So let's look at some of the challenges. Let's put them down. Number one, coordination. 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 Now, these are all segregated. One thing that, let me put the second down up, then I'll mix the two up with the explanation. The second one is goal congruence. I hope you've heard this word before. Goal congruence. What is it about, Adina? He said you've heard it before. Goal congruence. What is it about? Hey. Answer me, you've not heard it before. Oh, Charlie, people are not lying, you know. What is goal congruence? Now, what is coordination in the first place? What do you mean to coordinate something? Coordination. Come on. These are English words too. We don't even need you to be management accountants before you tell them. Coordination. You see, since the organization is now segregated to various divisions, all the operations, services of the various departments, various divisions would have to be brought together, synchronized in order to achieve what? The corporate objective. Are you getting it? In order to achieve the corporate objective. So the necessity of coordination is very important for the achievement of corporate objective. But the thing is that it is always difficult to coordinate their operations, because this guy will have a different production line, this guy will have a different production line, this guy will have a different production line. But how do you coordinate? How do you synchronize? How do you ensure that they are all in line so we are achieving the corporate objective? That is a challenge that we face if we are using divisionalization. Goal congruence simply means ensuring that management of various divisions don't pursue their own interests but pursue the corporate objective. What does that mean? One will say, if you do divisionalization, every manager of a division will become guy. Okay? Gai simply means they want to show that they are making more profit than at the expense of what? Another division. But goal congruent simply means ensuring that they are not pursuing their individual egotistic goals, but rather whatever they are doing is in alignment in the achievement of what? The corporate objective. That is what we mean by goal congruence, where you fuse all of them, their goals, and focus to the achievement of the corporate objective and not just the individual interest of various management or managers of the various divisions. Third challenge we face is head office cost. Head office cost. And I've already mentioned this. Head office cost would have to be apportioned. The question is, how do we apportion the head office cost? How do we apportion the head office cost? That is also a challenge that we face when we are dealing with divisionalization. Fourth, transfer pricing. I've already told you about transfer pricing, that it is the price at which a division sells its output to another division. Now, the question is, at what price must one division sell their output to the other division? That is also another challenge that the entity faces if it has various divisions within their company. So determination of the transfer price is always a challenge, it's always difficult for an organization that undertakes divisionalization. Then, controllability. Controllability. Now, immediately an entity undertakes or segregates its operation into various divisions, it means a manager will be responsible for that division. It then means that each manager of that division would be what? Evaluated. What we are saying here is that what level of controllability, independence, do we deem to be fit that we can allow to various divisions? Because remember, the head office is there, but should the head office be involved in their operations? Should the head office allow them to make various decisions? How? Controllability is also a challenge. Which one? Yes, I'm mentioning that in order to enhance performance evaluation of each division, managers of various divisions' performance will have to be evaluated. However, you can only evaluate someone's performance if the person is allowed to control and make decisions in relation to that division. But the question is, because the head office is there, what level of control can you allow them to have on their own? In other words, will the entity have a centralized decision-making procedure or a decentralized? What's the difference between these two? You did corporate strategy. What is centralization and decentralization? You did this one in citizenship, social studies, move your name or class. And our friend one. Centralization. What does it mean to centralize the power of decision-making? At the head office, in the hand of the top management, but decentralization is where what? Division make their own decisions. So controllability means, should we allow them to make their own decisions so they can become accountable for? That is a challenge. That is a challenge. Because remember, I told you something in goal congress. Each manager will feel gaga. So if you allow them to make their own decision, they would make a decision that will actually be at a detriment of the what? Company as a whole. So to what extent do we allow them to make their own decision? That is a challenge that we face as an organization. And then the last one is the interdependence. Are you okay? The interdependence. The interdependence of divisions. Interdependence of divisions. When you undertake divisionalization, it means one division is going to be dependent on the other. Now, this is a challenge because if my productivity will be dependent on the efficiency and productivity of another, then if I don't do well, don't blame me. That is a challenge that we face here. So I have an assembly department that assembles the finished product, which is our car. Now, if the tie department doesn't bring the tie, the seat department doesn't bring the seat, the windscreen department doesn't bring the windscreen, how do they assemble the car? So interdependence of divisions was also a challenge, a problem that an organization faces when they are undertaking divisionalization. So if these are the problems that we encounter, the question we then ask ourselves is, how do we manage each division? So management of divisions. Management of divisions. Now, many divisions' performance are evaluated and they are remunerated based on their performance results. For that reason, divisions can be either cost centers or profit centers. I believe you won't ask me the meaning of these guys because you know them already and I'm coming to ask you very soon. Now, for cost centers and profit centers, the way we manage them is that we are going to make them to use both financial and non-financial performance measures, and I'll come to this in a moment. However, for investment centers, the way we manage them and enhance see their performance is to use the residual income as well as the return on investment. So my question then is, what is a cost center? What is a profit center? What is an investment center? And why do they have different performance indicators? Yes? Where your introduction? Yes? Come on. Cost centers. Oh, maybe in count. This is a monk and Melcoming and in a private center. Kingsley. Agoima. Where cost is being incurred. So you are saying that profit center we don't get cost, investment center we don't get cost. Who's that? Come again. Yes, it's not just where a cost is being incurred, but okay, to some extent it's true, but management accounting students shouldn't give us, Palan definitions. Yes, who else can try? Edwina. Enrico, what do you think? What do you think? Now, cost centers are simply departments, a location, a machine, or even a group of people to which cost can be what? Allocated. Okay? So when you use the word a place where cost is incurred, yes, to some extent we can accept that. So for cost centers, the way we measure their performance is to use what? Both financial and non-financial performance indicators, and I'll come back to that. With profit centers, these are the centers which we can allocate both what? Revenue, as well as what? Cost. In other words, these centers can incur costs and at the same time can collect what? Revenue. So they become profit centers. Investment centers are just like profit centers, but there is a right to make what? Investment decisions. Okay? So the investment centers are just like profit centers, but here the center has a right or can make investment decisions. And we looked at this in the beginning of our discussions. We will refer to your notes in the beginning. We discussed all of these points there. Okay, so let's look at these indicators one after the other. Let's start with the financial performance indicators. Financial performance indicators. Now, there are a lot of financial performance indicators that businesses can use in order to appraise the performance of a division or a cost center or a profit center. Some of these performance indicators include the following. Number one is to talk about the objective of profit making. The objective of profit making. For profit organizations exist in order to make what? Profit. So one way they can measure their performance on financial grounds is how much profit what they make during the year. So the objective is to make profit. So if the objective is to make profit, the question is, how much profit did we make last year? How much profit did we make this year? If the profit we made last year is less than the profit we made this year, then it means this year our performance has what? Gone up. So one financial performance indicator is linked closely to the objective of the organization making profit. Second thing is maximizing the wealth of the shareholders. So maximizing shareholders' wealth. Now, what are the concerns of shareholders? What do you think shareholders are concerned about when it comes to an organization? Any ideas? What are shareholders concerned about? Primarily, if we put it in a nutshell, shareholders, what are they concerned about in the company? Mm-hmm. Making profit and getting their dividends. Okay. So will you agree that shareholders are concerned with the current earnings of the company, the future earnings of the company, as well as the dividend policy of the company? So these are the three things shareholders are concerned about. The current earnings of the company. How much is the company making now? The future earnings of the company. How much is it likely the company will be earning? And then the dividend policy of the organization. If this year we pay a dividend of say $20 per share, and next year we are paying a dividend of $10 per share, shareholders will say, hey, you guys are not doing well. Because dividend is supposed to rather go up in relation to that. So that is the second thing, maximizing shareholders' wealth. And because shareholders are looking at the current earnings, the future earnings, and the dividend policy of the company, this is also linked closely to the performance evaluation of an organization. The third one is very critical, and that is survival and growth. Survival and growth. Survival and growth. When we say a company's survival, what do we mean? When we say a company's survival, what do we mean?
Your ability to stay in business.
Okay. For a long period of time. Okay. So survival and growth is subdivided into three objectives. That is, one, the ability of the company to make profits. Two, the ability of the company to continue in existence. And then three, the ability of the company to maintain growth maintain growth and development. So the survival of the company. Can this company survive? In order for us to assess whether the company is surviving, we must ask ourselves, is it making profit? Number two, the profit the company is making, can it continue to exist? And then number three, can the company maintain the current growth or even develop itself into improving in other aspects of the business? So generally, when we talk about financial performance indicators, these are the guiding rules that we use in assessing an organization's performance indicators. But let's look at the things that you know you're going to be looking at. So we can look at this in details by looking at the various financial ratios that are used in order to assess these performance indicators. And you know this already from your financial reporting class. Thank God you all did financial reporting. And these are profitability ratios, liquidity ratios, gearing or gearing ratios, depending on the school you attended, and the teacher who taught you phonics. Then investors ratios. Now you know these things already. I'm not going to go through them any longer. Go and look for your notes. Go and look for your notes and do revision in them. Now, profitability ratios, as the name suggests, measures how much profit the entity is making. Liquidity ratios, or what we call the working capital ratios, measures the short-term liquidity of the company, that is the ability of the company to pay its short-term debt as they fall due. The gearing or gearing ratios measure the ability of the entity to pay its long-term debt as they fall due. And then the investors ratio look at the returns that the investors are going to be making on the financial performance of the organization. So basically, that's what you need to understand in relation to that. I think later on, if we have time, I would maybe let us revise these things again. In that case, I'm not going to go anything deeper here because there are other deeper stuff that we need to look out for here. But on financial grounds, we can measure the performance of the organization like this. So in a nutshell, when we are measuring the financial performance of the organization, four things. Number one, profitability of the organization. Number two, how much revenue the company has made. Is revenue growing or falling? Number three, the return on investment that we have made. Number four, the cash flows of the company. So in a nutshell, when we are looking at the financial performance indicators that will be used is profitability, revenue, return on investment, and what? Your cash flow. In other words, if we have a division, we will find out how profitable was the division, how much revenue did the division generate, what was the return on investment for the division. Now remember, return on investment, I'll be looking at this later on though, but return on investment is simply profit divided by investment. Okay, so for instance, if that division has a total investment of say $20 million, $20 million, and from that $20 million, they are able to make a profit of say 1.5 million, then we will say the return on investment is going to be what? The 20 mil minus A per mil. The 1.5 mil over what? The 20 mil, okay? Times 100. Can I have an answer, please? Just for my illustration. $7.5. Is it good or bad? Is it good or bad? Is it good or bad? Anybody that will answer the question, Obeti, is it good or bad?
Not bad.
Not bad. Okay. It depends on what. Because yes, so we cannot just calculate this and say it's good, it's bad. There has to be a benchmark against which we have to what? Compare this. Are you getting the idea? So that is return on investment. Then the brother of return on investment is, remember there is one also called ROCE. ROCE is return on capital employed, and that is going to be the net profit over capital employed. You see, I said you knew these things already. Shucks. Times 10%. So net profit over capital employed. Now remember, capital employed is equal to total assets minus current liabilities. Or there are two ways. You know that, right? Total assets less current liability. What's the second thing? Shareholders fund plus long-term finance. Are you getting it? Shareholders fund plus long-term finance. So these are the two ways that that will be ROCE could be calculated. Sorry, capital employed could be calculated. Then the brother of them, the last guy there, and these are performance measurement module for divisions. Is residual income. Residual income. What is the residual income? The residual income is simply the profit minus notional interest. Notional interest. Profit minus notional interest. Now, what is the meaning of that? What is the meaning of that? Notional interest simply means the interest we have to pay to the providers of what? Finance. So let me crunch some numbers to illustrate this for you. Let's say that the company has an investment of $10 million and require a rate of return is 12.5%. Let's say that the profit for the company is, let's just say, $5 million. The question is, what will be the residual? You see the word, what is the meaning of residual? When we say residual, what does it mean? Asero. Hey, this guy is heartless, so say asero. Okay, so the profit that will be left after we pay providers of what? Finance. That is called the residual income. So that is why it is profit minus what? Notional interest. So from this scenario, if you want to calculate the residual income is going to be the profit we made, which is 5 million, minus notional interest. So listen, this is the investments we have. The investments, they are requiring a return of what? 12.5%. That is called the notional interest. So 12.5% of $10 million, that gives us what? 1.25 million. So what do I have? Residual income. 3.75. Okay. It means this is the money that will be left for the company. It is called free cash flow. Okay? This is the money that will be left for the company after they pay the providers of finance the returns that they require. That is the idea about it. So, ROI is there, profit over investment. ROCE is there, profit over capital employed. RI, residual income, profit minus what? Notional interest. All of these are financial performance measurements for divisions. So this is what is going to happen, not what is going to happen, but what may happen. I need to clarify my words very well. This is what may happen in the exam hall. You will have 3 divisions. Then the examiner will ask you to assess their performance. So when you're assessing their performance, you are going to be using what? ROI, ROCE, and RI. So when you assess, based on the results you have, then you can compare and you make a decision. Whose one is high, whose one is low, why is whose one is high, and then you explain all that. So these are the 3 core things that you need to understand when it comes to the performance evaluation for the divisions. Any questions? Capital employed. Yeah. Less current liability. Yes. Shareholders fund. And then long-term finance or long-term loan. Now when we say shareholders fund, what does it include? Stated capital, okay, retained earnings, and then any reserves. These are called shareholders fund. Okay, so either this method or this, it should give you the same answer. It will give you the same answer. Whether you go this approach or this approach, you have the same answer for the capital employed. Does it make sense? Are you okay? Shareholders fund plus long-term loan. Yes, plus long-term.